Welcome to the Bamboo Brief, where we break down the financial news that matters to you. Today, we're diving into PepsiCo's latest earnings report. Now, on the surface, it looks like a huge win, but if you dig just a little deeper, you'll find a surprising challenge hiding in plain sight.
Okay, so this is the number everyone on Wall Street is talking about. PepsiCo posted adjusted earnings of $2.29 per share. Now, why is that so significant? Because it absolutely sailed past Wall Street's expectations. This isn't just a rounding error, folks. It's a really clear sign of outperformance. And when we look at the other key metric, well, the story just gets even better. It was a solid beat on both the top and the bottom lines. While analysts were looking for revenue around $23.83 billion, PepsiCo came in and delivered nearly $23.94 billion. A beat like this on both fronts is exactly the kind of confident signal that gets the market excited. And yeah, the market reacted just how you'd expect. Shares climbed almost 2% in pre-market trading. But as investors, we know the headline is never the full story. So let's peel back the layers and see what's really going on under the hood. So this is where the story gets really interesting. If you look at net income year over year, it actually went down from $2.93 billion down to $2.6 billion. So you got to ask, how can revenue be up but profit is down?
Well, the answer really comes down to one thing: softer demand. That negative 1% you see, that represents a drop in worldwide volume. It's a super critical number because it shows that even though we're all paying higher prices, people are actually buying fewer bags of chips and bottles of soda. And the source of that slowdown? It is much closer to home than you might think. The biggest challenge for PepsiCo right now is happening in its biggest market. That's right, both of PepsiCo's main North American divisions saw their volumes shrink. The food side, which has those huge brands like Doritos and Quaker, was down 4%. Meanwhile, the beverage side was down 3%.
So that's the central challenge, right? Higher prices are kind of masking the fact that fewer products are actually being sold in their biggest market. But PepsiCo isn't just standing still. Their leadership has laid out a clear and pretty aggressive plan to turn things around. And you can see from their own words, the top brass is tackling this North American slowdown head-on. Their whole turnaround strategy is really built on three key pillars. First, they're aggressively cutting costs to protect their profit margins, which makes a lot of sense. Second, and this is where they're really playing offense, they're speeding up innovation to get new products on shelves faster. And third, they're rethinking pricing and even their package sizes to appeal to consumers who are feeling the pinch. And that innovation, it's not just talk. We're actually seeing it in action with products like Doritos Protein, which taps right into the health craze, and cleaner labels on classics like Lay's. Beyond their own brands, they're making some really savvy investments, benefiting from the massive growth of that prebiotic soda poppy and taking a big stake in the energy drink giant Celsius. This is a brilliant illustration of how the company is adapting to meet new consumer demands. So let's talk about the view from the top. The company's leadership sent some really strong signals about stability and their confidence in the future. And for investors, this is maybe the biggest vote of confidence you can get. Despite that slowdown in North America, management is holding its full-year forecast steady. That signals they truly believe their new strategy and their strong international sales are going to carry them through. The company is also looking to the future with its leadership team. They've announced a new CFO, Steve Schmidt, who's coming over from Walmart, and he'll be taking the financial reins, bringing a fresh perspective to guide their strategy forward. So, after digging through all the numbers, what are the key takeaways? Let's boil it all down to what you really need to remember from this report. So, in short, the headline numbers were great, no question. The core challenge is that volume decline at home. But, and this is a big but, management has a clear, proactive strategy to fix it, and it's all being supported by strong international sales and a confident outlook for the year. And this leaves us with a final thought to consider. We're basically seeing a company in transition, leveraging its global strength to buy time to reinvigorate its home market. So the big question is this new strategy going to be the catalyst for their next big growth spurt? You know, thinking about moves like the ones PepsiCo is making is what investing is all about. If breakdowns like this make you want to start your own journey, the Bamboo app is a great place to begin. There's a referral code down in the description if you'd like to support our channel as you get started. And we would love to know what you think in the comments. Do you believe in PepsiCo's comeback plan? Your engagement really truly helps us bring more explainers just like this one to you.
Thank you for watching the Bamboo Brief. We'll see you next time.